word of the day when it comes to banks is unhinged, and perception is unhinged from reality. In fact, if you look out over the last 12 months, the performance of bank stocks relative to the broader market has been the worst in history. The last 12-month relative bank stock performance is worse than the global financial crisis, when Enron and WorldCom failed, the failure of long-term capital. So the perception is that banks will crumble under the weight of COVID and low interest rates. But the reality, as you pointed out, the results last week were fine. The future guidance is actually a little bit better. We wound up increasing many of our estimates for the large banks. Credit costs actually went down a little bit quarter to quarter. And the most important point is that it showed that this is an income statement recession. Yes, earnings are down, but it is not a balance sheet recession. And the one figure I'd point out is that despite banks absorbing 4 100-year floods at the same time when it comes to NIM and net interest income and revenues and reserve builds, despite that, they absorbed it and book value still grew 7% year over year. So perception is not linked with reality.
So, Mike, what's the catalyst for the share prices to turn around? Because that point you just made, that this is an income state recession, not a balance sheet recession for the banks, I think I'm right in saying you said after the prior quarter, perhaps even the quarter before that. So what is the trigger that means the share prices also respond, not just some of the earnings numbers?
Well, it's a fair question. We did lower our estimates and our targets at the start of the pandemic. We have been saying that this is a 1 to 2 year process. We're in probably the third inning right now. There are a lack of catalysts, and that's why the bank stocks have underperformed. Having said that, it would not take much for bank stocks to start outperforming. It could be a higher 10-year Treasury yield. It could be an additional stimulus package, as you were talking about. It could be the resumption of buybacks and dividend increases sometime next year. That certainly seems likely. Or it could be some advancement with the stage of COVID. Bank stocks have the highest COVID beta, meaning that the bank stocks are the most sensitive to developments with COVID on the way down. And if and when we go back up with the COVID situation, bank stocks should follow too.
Yeah, Mike, we've seen Treasury yields start to rise in recent days. We've seen stimulus hopes start to build. It's affected the rest of the markets. What do you say to those that have just given up and say it's a value trap?
Well, it's when I was in business school, it's like there's a $100 bill on the ground, and the professor says that's not a $100 bill because the market's efficient, and the astute investor picks up the $100 bill because it's an opportunity. So what I would say is this is an opportunity. You are seeing a little steepening of the yield curve, depending on the stimulus package. We're talking about record government spending. You're talking about like $2-3 trillion of additional spending. And the knock against banks is, well, the credit losses are going to go a lot higher. Well, banks have reserved for those credit losses more than ever before in the history of banking. Oh, and by the way, that government stimulus certainly helps out a lot of the bank borrowers. So I'm not sure, why the general stock market is going so much higher and leaving the banks behind, because they are connected.
Shepard Smith here. Thanks for watching CNBC on YouTube.